Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer. Today, we're going to be analyzing Tractor Supply Company. This one came in by request in the comments of one of my other videos. If you have a request, put them down in the comments. I'll get the tickers up on the chalkboard behind me, and when I do that, I'll let you know that I've got it on my list. Usually, I go through a couple times a week and add the new tickers. Running a little bit behind on these, so I'm going to be focusing on trying to get caught up, maybe not through all of them, but to kind of get through more than normal in the next week or so, rather than doing my Kramer versus Kramer and thoughts for Thursday. So I'm going to, since it's a shortened trading week, I really don't have too much to talk about anyway, so I'm going to kind of get the nose to the grindstone on these individual stock analysis and try to get these out for folks. As always, it's not individual investing advice, just how I analyze stocks. Okay, so the ones I don't post here, I'll post over on the free tier on Patreon, so make sure to check out that link down in the description. And then also I have weekly picks on Patreon for $25 a month, and those have been doing really well, outperforming the S&P 500 so far, so that's been great. So again, check those links out down in the description. All right. Tractor Supply Company. This one's been on my list for a while, and I was scanning through today, and I thought it would be a good one to discuss because I bought. So if we look at the historical earnings pattern here on the fast graph, let's get rid of the dividends. We don't need those. Shorten this up a little bit. Okay, so if we go back, let's even shorten it up a little bit more. Go back to the Great Recession. There we go. We can get each individual year's data. So kind of the dark green area kind of shows the earnings pattern here. That's usually the first thing that I look at. Earnings per share fell about 9% during the Great Recession, which isn't really too bad given everything that was going on. Let's see kind of what the stock price did. So it peaked pretty early along with the housing market back then. It actually bottomed kind of early too in this process. So in 2008, so it fell about 60%. It's about the same as the market. So not super cyclical historically earnings wise. And the stock price even back then wasn't any more cyclical than the market. So that's all kind of average. That means we can use an earnings based analysis for the stock. If earnings were fluctuated a lot, we would want to use a different type of analysis. But since they're relatively steady and almost always going up historically, earnings are a good way to estimate future returns. So let's do that, and let's shorten this. Okay, this gives us a view of like the past 10 years. Now, we did obviously have some events going on here that would boost earnings growth. We had the 2018 tax cuts. We had the COVID lockdowns, which these guys did a lot of business during those because they had a good mobile app and people could go and get their supplies without having to go into the store. And so they actually grew earnings quite a bit during COVID, and they managed to keep those. Of course, there was a bunch of stimulus as well. So what I find interesting about these guys is they kind of held those. Like a lot of companies that had this kind of boom eventually had the earnings growth kind of go back to what the previous trend was. So far, they've been able to hold that trend, but I'll talk about that a little bit more here in a minute. Now, I was fortunate enough in the Cyclical Investors Club to buy this one. We basically bottom ticked it. I think March 16th is what I have down as the purchase date. So right in between here. I think it was actually a little bit lower than $15, maybe, probably closer to this in between 14 and 15, which they have as the low. And it was up about 300% here as of a couple months ago. And you can see that it's kind of started to come back down right now. So I recently sold half of my position. I had kind of had in my mind that this would just basically be kind of a buy and hold. I mean, I've had it 60, this is the 6th year now going into it, but, and I hadn't really been paying too much attention to it, except for when I was doing my regular updates. But And I expected there to be kind of a slowdown after the stimulus boom and all that. And now we have, maybe the economy slowing down a little bit. I mean, we had negative GDP slightly last quarter. So the slowdown might not be anything specific to them. They also made a pretty decent sized acquisition during this time. So those are all things companies kind of do when growth is slowing a little bit and they're trying to find new ways to grow. Usually not great for the stock, but the main thing here is earnings growth 2023 was 4%. That was probably the inflation rate, so none. 2024, again, 1%. That's slightly negative, I would say, inflation adjusted. And then this year's expected to kind of be the same, basically flat nominal, probably flat inflation-wise too, pretty close to it. So growth is kind of stopped, but it hasn't reversed like a lot of companies and reset yet. But there's definitely signs of slowing here for earnings growth. And so the stock trades at like a 25 PE. It was somewhere around there when I sold it, sold half. I decided to just keep the other half. The other thing that kind of spurred me, I'll look at the valuation in just a second, but the other thing is I think tariffs are going to have some kind of impact on these guys. It might not be huge, but it could be enough to just make earnings growth difficult to come by. So that was another sort of reason for me selling half my position. And then I've kind of committed to holding the other half longer term, unless I see signs that there's more of a permanent kind of issue at some point, not just a valuation kind of issue, which is what we have now. Okay, so what I want to do here is I want to do a valuation analysis where if a person bought the stock right now or bought the whole business right now, how long, given the trends of the past 10 years or so, would it take to earn your money back from the money that it took to buy the company, including the debt, which I have about at a 24% premium. So that's the total enterprise value here, at least the last time I adjusted it. And that looks about right, just eyeballing it. So that's the difference between the market cap and the total enterprise value. So you're going to buy the company, you're going to buy the debt, and how long would it take you to earn the amount of money that you spend on it back just from the company's earnings and earnings growth? I'm going to assume that earnings grows at 9.37%. So during this period, FastGraphs has 13.24% growth from here to up here. But I adjust for buybacks, and I think they bought back some stock. So I adjust for that, and that will lower the expected earnings growth. We also know that some of the tax cuts are one-time deals. Stimulus is a one-time deal, so it's better to be more on the conservative end for your earnings growth estimate. And then, so the market is looking at 2% this year, 11% and 12% after that. So my a little over 9%, it seems reasonable. It's not optimistic, but it's not super pessimistic. Like, we aren't going to take just the 2 years recently or 3 years and say that they only can grow at 4%, right? So I'm being in the middle. I think it's just a reasonable estimate. Okay, so that's the earnings growth rate. Now we are going to go and see how long, and just do a calculation how long it would take to earn our money back. So the stock's trading a little under $50 a share. I'm treating it like it's trading about $61 a share to account for the debt. So we're going to buy all that and see how long it would take us to earn our money back. Now the way to do that, you basically need two numbers. You need the earnings yield, which is 3.4%. The earnings yield is the PE ratio inverted. So PE ratio is price over earnings. All this is earnings over price. It's really the same thing, but it's expressed in a different way. And when it does that, it allows me to calculate things a little easier. So 3.4% would be like if you paid $100 for the business, you would earn $3.40. And then that per year. And then I assume that $3.40 grows at 9.37%. And I pull the first year forward. Okay. So the earnings growth estimates have actually been coming down every time I update. So they're down to, they were 214 just I think I updated it last month. And now they're 208 for this year. So things are getting a little less optimistic for earnings. But I'm going to assume they earned $2.08 this year, and then I'll build in a 9% growth rate, that 9.37. So let's see what this looks like. So the first year, we would earn $3.72 on a $100 investment. The next year, we would earn $4.07. And then I just assume you're like the owner of this business, and you can keep that. You can go do whatever you want to. So we're not adding in buybacks on top of this, or I'm actually would exclude them, because often the companies will pay dividends, do buybacks, but all that comes out of this money, right? If you own the business, first you earn the money and then you pay the dividends with the earned money. You don't put it on top of it, which I actually see a lot of people do. And the same goes for buybacks. I like to make sure that I don't assume that they're buybacks. Like if you own this business, you could take your money, your profits, and you could go buy a boat or whatever, and the business would continue to grow organically at that 9% rate, and then you could collect the money. So this is the idea how this works. So each year you go along. What I want to know is how many years would it take you to earn back $100, right? Using this method. And the answer to that is about 15 years. So the time until payback, using these assumptions, it's about 15 years. Usually when I buy a stock based on earnings and earnings growth, like 10 years is about what I want to see to have kind of a margin of safety, and then there's minimum metrics too. Like I want earnings to at least be growing 5% a year. So it is still, I have a certain growth that they have to meet expectations. Because value investing can look cheap. You might be able to earn your money back fast, but only if earnings don't decline. So I basically always want earnings to be growing at a decent rate, which is for me is about 5% a year at the minimum. That's not really a problem so far with Tractor Supply, at least with my assumptions. And so 10 years is where I would look to buy. 15 years is about where I look to sell. So that's a long time to wait to earn your money back. I mean, if you think about it, assuming you can reinvest at similar rates, if you earn your money back in 10 years from an investment in a company, that means you can double your investment every 10 years, just based on earnings, no market sentiment or anything like that. So you could take your $100, in 10 years you would have $200, right? And then in 20 years you would have $400. And then in 30 years you would have $800. Pretty sure how that's worked, assuming you can get it reinvested. But if it takes 15 years, it takes 15 years to get to 200, and then 30 years to get to 400, right? So you're earning half as much money over a 30-year time period if you're investing in businesses that take you 15 years to pay you back on average. So chances are and this is just a rough cutoff, but this is a pretty decent cut. Usually if it's going to take more than 15 years, usually you can find something else in the market that you can earn your money back faster, that's not any more risky, that has decent growth and everything else. It might not be 10 years like I'm looking, maybe it'll be 12, but usually there's something that you can find. And then usually, I mean, cash is paying like 4% right now. So you're going to earn money just in cash. Like that's going to pay you back, and it'll probably be longer than 15 years, but you have liquidity, you have no risk really. So there's a certain point where cash starts to be, and waiting for those good deals becomes kind of a better opportunity. So that's where I'm at on Tractor Supply. Now we can test a couple numbers to see where to buy, which I didn't do ahead of time, but I can do it right here. So if we wanted this to get down to like 10 years, I'm guessing 20. We'll try 25. I think it probably needs to fall like 50% or more. Yeah, there we go. Yeah, so $25, and we can go up and see when it would. Yeah, so that would be kind of the lower end of hitting the 10 mark. It might be 30. I'm just testing a couple. So $28 a share is what you'd be looking at for a buy price, right? So a little less than half of what it trades at right now. And that seems pretty reasonable to me to aim for if you were looking to buy it. You want a pretty big discount. I mean, when something's overvalued that much, potentially, then, and you want a margin of safety, and then, fair value would be somewhere in between there. So it's probably, $36, $37 share, something like that. It's probably like a fair value. That's when it would take like 12, 13 years payback. All right, if you found this useful, hit the like and subscribe button. If you have a request, put it down in the comments. Like I said, I'm going to try to get through a big chunk of these, kind of get caught up on folks' requests this week. And I'll probably be I'm going to aim for a couple a day, but we'll see how it goes. All right, thanks for watching, everybody, and see you later.